Let's take a look at recording common stock, treasury stock, and cash dividends. Carl Corporation designs and produces a line of golf equipment and golf apparel. Carl has 150,000 shares of common stock outstanding as of the beginning of the year. Carl has the following transactions affecting stockholders' equity during the year. On March 1st, it issues 60,000 additional shares of $1 par value common stock for $50 per share. On May 10th, it purchases 10,000 shares of Treasury stock for $58 per share. On June 1st, it declares a cash dividend of $1 per share to all stockholders of record on June 15th. On July 1st, it pays a cash dividend declared on June 1st. And on October 21st, it resells 5,000 shares of Treasury stock purchased on May 10th for $62 per share. We're going to use this information to record each of these transactions. On March 1st, the company issues 60,000 additional shares of $1 par value common stock for $50 per share. The cash that we will record will be the amount that we received, so 60,000 shares at $50 per share, or $3 million. The remainder will involve common stock and additional paid-in capital. Now, the common stock we will record at par value, so 60,000 shares at $1 per share is $60,000. The additional paid-in capital will be for the difference. So you take $3 million minus $60,000 to get $2,940,000. This is issuing common stock above par. On May 10th, the company purchases 10,000 shares of Treasury stock for $58 per share. So the Treasury stock amount will be 10,000 shares times $58 per share, or $580,000. You will credit the same for cash, and this is what it looks like when you purchase Treasury stock. On June 1st, the company declares a cash dividend of $1 per share to all stockholders of record on June 15th. As a hint, dividends are not paid on Treasury stock. So, we had 150,000 shares in the beginning, plus an additional 60,000 shares that were issued on March 1st, minus the 10,000 shares that were purchased for Treasury stock on May 10th. This brings us to 200,000 shares. We're going to multiply that times $1 per share to get a cash dividend of $200,000. So we will debit dividends $200,000 and credit dividends payable for $200,000. This is us declaring the cash dividends but not paying them yet. Now, on July 1st, we pay those cash dividends that were declared on June 1st. On July 1st, we will debit dividends payable, clearing out that liability, and credit cash, both of those for $200,000. On October 21st, the company resells 5,000 shares of Treasury stock purchased on May 10th for $62 per share. So the cash is going to be the amount that we received. So 5,000 shares at $62 per share is $310,000. Now the Treasury stock, we will enter at the cost that we originally purchased it at. So originally it was purchased for $58 per share. So you're going to take those 5,000 shares times 58 per share to get $290,000. The difference will be additional paid-in capital. The additional paid-in capital is calculated by taking the cash amount, $310,000, minus the Treasury stock amount of $290,000 to get $20,000. This is you reselling the Treasury stock.